Got it. Thanks, Sue. I just wanted to start by saying that our process here at Benchmark is we're going to send out the closing disclosure when the loan is clear to close. The spirit of this document is that it's sent out at least 3 days prior to closing, and it is a final document. You'll find some people out there that send it out early, and the numbers aren't final. We're trying to start the 3-day clock, but the actual spirit of the document is to have a final closing disclosure out to you at least 3 days prior to closing. So I'm going to run through these slides, and I'm going to go pretty fast, and I'm going to follow it through as if you're a customer. Okay. So the closing disclosures is your final itemized document breaking down all the closing costs and what's due at closing. It's a document provided to the borrower by the lender before closing on the mortgage loan. And by law or by policy, it's got to be provided at least 3 days prior to closing. You can go to the next slide, Sue. Again, the closing disclosure is required by law under RESPA and the Truth in Lending Act. This law was created to protect consumers from unfair and deceptive practices. So to make sure that there are no last minute changes that the customer is unaware of. Okay. Go ahead, Sue. So this is where we get into the nitty gritty, and I'm just going to read through it as if you're the client. So this client, if you start at the top section under closing information, it shows the date issued. So in this particular closing disclosure, it's issued March 14th, 2023, with the closing date is March 17th, 2023, and the funding date is March 17th, 2023. So you've got the document issued 3 business days before closing. Saturday is also considered a business day in that calendar. Okay. The middle column is the transaction information, which is buyer and seller's name and mortgage company. The right-hand column is the loan information, a 30-year fixed, purchase, fixed rate, and conventional mortgage. So pretty standard. There's not going to be any significant difference in from loan to loan on this section, other than the buyer and the seller and the lender. So the first section of the closing disclosure under loan terms, these are your loan terms. This is how much you borrowed, which is your loan amount, the interest rate, and the monthly principal and interest payment. This, again, it's just principal and interest. It's not taxes or insurance. So these 3 items will never change. Your promissory note will always have the start rate or the start amount, loan amount of 503,405 in this case. Your interest rate can never change. It cannot change if it goes from one servicer to the next. That is your interest rate. And the monthly principal and interest payment cannot change. The taxes and insurance can change, which affects your overall payment, but the principal and interest payment cannot change. And of course, in today's mortgage market, there are, on a standard conventional loan or FHA or VA or USDA, there are no prepayment penalties and no balloon payments at all. Okay. You can forward, Sue. So this next section represents your projected payments. So in column 1, in years 1 through 12, you have your principal and interest payment, your private mortgage insurance, and your estimated escrow, which is your property taxes and insurance. And it gives you a total estimated monthly payment. The reason it says estimated is because taxes and insurance change year over year. That's the variable of the monthly mortgage payment. The column to the right represents the payment after the PMI falls off. Okay, so in this particular case, the PMI is expected to fall off after year 12 when they're at 95% financing, and that threshold is based off the original purchase price. Okay, so if the value goes up 20%, like we saw during COVID, the 80% threshold is still going to be based off that original purchase price. Okay. The next section underneath shows estimated taxes, insurance, and assessments. So this shows the property taxes, the homeowner's insurance, and they both show included in escrow. That 851 number also includes HOA. And you can see the HOA is not included in the escrow account. You pay your HOA separately. HOA is still considered a housing obligation, so we have to account for it. Okay. And then I typically skip this last line because the data is more detailed on the next couple pages. So let's skip through that cost at closing. So this is where we get into the nitty gritty. This is the itemized breakdown. So in this particular case, the borrower paid 1% of the loan amount as a discount point. There's the administration, processing, underwriting fees. And each lender might call these something different or might only have processing and underwriting, but the costs are higher. National average for this is about $1,600 to $1,700. And they might label them different. It's just the cost of their overhead. The next section is section B, which is services the borrower did not shop for. That means we are doing it on their behalf. So we are ordering the appraisal. And the cost of the appraisal is in the right-hand column. It's borrower paid, but it's before closing. So it's not included in their cost due at closing. We move it from the left column to the right. In the loan estimate, it's in the left column. In the closing disclosure, it's in the right column because it's already paid for. Okay. And then the next line is the document preparation fee, which we all know in Texas, every mortgage loan, the closing documents are prepared by a closing attorney, not the actual mortgage company. Okay, they've all got to be reviewed and prepared by a closing attorney. All the closers actually work for the closing attorney. Okay. The next line item is the survey. The seller, in this instance, paid for a new survey. So that is in the seller paid column over to the right. Okay. The next section is section C, and these are services the borrower did shop for. Okay, so shop is depending on how you interpret it, but most of the contracts come with a specific title company. Okay. You have your title company fee, your e-recording fee, your guarantee fee, the lender's title insurance, the settlement fee, and the title endorsements. Now, this is one of the two questions that we get the most from borrowers or buyers are, what are title endorsements? And why does these documents say the title insurance, owner's title insurance is optional? So we've got Alicia here with Chicago Title that's going to jump in and explain those two pieces for you. So Alicia,
so as far as the endorsements go, those are endorsements that the lender requires. They're tax endorsements, a not yet due and payable, a T-19 and T-19-2, which I'm sure doesn't mean anything to anybody. So what that is for the taxes, we ensure that the taxes have been paid for the lender. So if something pops up, we're going to defend that title for the lender. Same thing with the not yet due and payable, because our taxes come out in October. We have to put that in there stating, as of now, the taxes are not yet due and payable. When that tax bill comes out, then we adjust it. As far as the T-19 and the T-19-2, it's in regards to the survey, minerals, anything on the surface, okay? That is boundaries. That is, if anybody comes in with a mineral rights dispute, anything like that, we defend the lender's first lien position if they have a T-19 and a T-19-2. The other thing that comes in is if you live in a HOA, then you're going to have a PUD endorsement as well, which means we will help defend against that as well. So that's kind of a normal endorsements for the lenders. If you have an ARM loan, then there's going to be an additional endorsement for that. All that factors into what the total premium is then at that point. And if you think about it, so it's insurance. And when you get an insurance policy for your house, you'll get a jewelry rider or anything specific in that house that you want to make sure is covered, not just general insurance. That's what those endorsements do.
What about, our documents show that the owner's title insurance, it reads it as optional. And I would say I get that question probably on 2 out of 3 loan estimates and closing disclosures that go out that say, why do I have to, it's optional. Do I have to pay for it?
Yeah, we get that a lot as well. As you and I talked earlier, well, bottom line, most title companies will only close on a purchase if there's a simultaneous issue. And that's one, which means an owner's title policy and a lender's policy. Quite frankly, it's beneficial for the owner. And number two, it gives them a discount. So if they don't get the owner's title policy, they're having to pay the full amount of the lender's title policy and endorsements. If you get an owner's title policy, it covers you, and you get a credit on the lender's title policy so that it becomes only $100. So in the long run, it's better coverage for your buyer, because if something comes up, we're not defending anything. And everybody says, well, what's going to come up? The biggest one I get is, well, it's a brand new house. Why do I need it? We're buying it from the builder. That's one of the times when you really need it. Not that the builders are bad by any means, but if somebody gets in conflict with one of the vendors and has a mechanic's lien put on it and you don't have an owner's title policy, you would be responsible for that if the builder defaults or walks away. So that's a really good time to have an owner's title policy. The other issue is, if you think about it, an owner's title policy is from the date of closing, not only forward to protect you, but it's for anything that happened in the past. So for instance, I know I've been doing this 30 years, a little bit over. I'm not going to date myself too much. But we had one come back, and this gentleman who was deceased was married that nobody knew. There was a child out there that nobody knew about, and he showed up. You don't have an owner's title policy, you can lose your house. So those things do happen. And just business-wise, it's good coverage for everybody, and it gives them a break on the title policy for the lender. And it makes it $100 plus just the endorsements, as opposed to full price in the thousands of dollars.
Okay. Yeah, I always coach the customer when they ask that question, that the owner's title insurance protects their investment into the property.
Absolutely.
Without that, if something were to happen, a title claim, and they could lose their interest in the property, lose their down payment, lose everything that they worked for.
Yes.
Because without that, they're not protected. Yeah.
Yeah.
Okay. Does anybody have any questions on that piece of it? Okay. So you can go down to the next page. All right, so this is this next page is other costs. That's what's labeled other costs. And the first line item here is the recording fees. This is the fee from the county to record the deed of trust and the mortgage. Okay, and each county is slightly different. They charge by the page. So you'll find, depending if it's Collin County, Dallas County, Tarrant, Fannin, or Grayson, you're going to find different dollar amounts there because the counties charge different amounts. The next section is what we refer to as prepaids. This starts with your 1 year of homeowners insurance due at closing. So that on this scenario, this policy covers from March 17th, 2023 to March 17th, 2024. The amount that we're collecting in escrow from the monthly mortgage payment is then used when the bill comes to the mortgage company in March of 2024, so that there's money in that escrow account to pay it. The next line item is prepaid interest. This is interest from the day the loan closes through the end of the month. And then on this scenario, the first mortgage payment is paid on May 1st. Mortgage payments are paid in arrears, meaning that May 1st payment covers the month of April. So you've got to cover the interest from say on this scenario, from March 17th till April 1st. The May 1st payment covers April. Okay. Then the next section is your initial escrow payment due at closing. So these are the funds that are put into the escrow account. You've got 3 months of homeowners insurance, and you have 6 months of property taxes. And I'm going to get to the property taxes on the next page as well, but that 6 months is from January through March, and then 3 months of escrow account for property taxes. Okay. And then at the bottom, you have, in this section, you have what's called an aggregate adjustment. An aggregate adjustment is because lenders can only carry 1/6 of the amount of property taxes and insurance in their escrow. So what the system does is it takes the yearly cost of property taxes and insurance, divides them, and then gives that aggregate credit back so that the lender is not holding too much in the escrow account. Okay. The bottom section are what we title other costs. These are HOA transfer fees, any kind of HOA capital contribution. It also shows the real estate commission for both the buyers and the seller's agent. And then there we go is the owner's title policy where it says optional. Okay. Okay, so you can go down to the next page. So this is a comparison of the original loan estimate, the total amount due at closing versus the final document. So in this example, you can see there's a pretty sizable difference there. And on this example, on the loan estimate, the earnest money was not placed on the loan estimate. So that's why you see that in the deposit section where it says 0 on the loan estimate and then 8,950 on the final closing disclosure. That's where that delta comes from. We're always going to be a little bit more conservative on this number so that will come down on the closing disclosure and not go up. That's the goal, is to have that number come down even slightly, even if it's $100, then rather than it go up. You do not want to have that call. Okay. You can scroll down too. All right, so this is where we get into the nitty gritty. So this first section on the summaries of transaction, it's labeled due from borrower at closing. And this is the sale price of the property, the total amount of closing cost. And then in this case, the seller has paid or prepaid, it looks like HOA dues through the end of the year. So those three items right there are the total amount due, which in this case, I think it says 548. I can't really see it. 548, 557 and 33 cents. So that's the total due at closing, the price of the house, the closing costs, and reimbursing the seller for their prepaid HOA. And the next section, which is section L, is paid already by or on behalf of the borrower at closing. So this is all the credits that are being applied. Okay, so you have your deposit, your earnest money deposit, you have your loan amount, you have your option fee is refunded to you. And in this case, the contract dictated that the seller paid the title policy. So we give a credit back for the title policy. Okay, the buyer has to pay for it on the previous page because it's their title policy. And then the seller gives them a credit back. Okay. And then in this case, the agent gave them a $535 credit. So that's listed right there as well. And as you remember on the previous page, we collected 6 months of taxes, which were from January through March, and then 3 months for your escrow account. Well, the seller owned the home January through March 18th, March 17th. So the seller provides a credit back for the time that they own the home. The seller cannot contribute directly to the escrow account. It's the buyer's escrow account. So we have to collect it from the buyer, and then the seller gives a credit back for their amount due. Okay. So how we come up with the money due at closing is we take all those credits. We take the credit for property taxes, the agent credit, the credit for the seller paid title policy, the option fee, the loan amount, and the deposit. And that grand total is 517 and change. So we're going to take the total amount owed versus the total amount of credits. And we're going to, in this case, we're going to come up with that 30,687 or 867 and 34 cents. Anybody have any questions on this section?
Will?
Yes.
I know you do a lot of these on Fridays. You and Mike do a lot of these going over with the clients. in this section, what are the questions that you usually get in here?
Most questions are just making sure that their earnest money and option money are credited back to them. Okay, that's really the biggest question. They want to make sure that all these credits match up to the terms of their contract. So when you walk them through that, you walk them through the contract and match everything up. That's the biggest, or probably the most prevalent question that we get during that process when we're explaining it to them, just making sure that they're getting all their money back.
And also, probably before they even get to this page, they see on page 2 where the title policy is being charged to them.
Yeah.
And so they stop right there and say, why am I being charged the title policy? And that's where you have to just say, hey, be patient. We're going to get to page 3 and show you where the seller is actually crediting that portion of the title policy back.
Yeah, exactly. And they do the same thing about taxes. So
Yeah.
when you go to the previous page and we're collecting 6 months of taxes, and they're like, well, I haven't owned the home for 6 months. And we just revert down to the next page. So for us, when we're explaining this, there's a little bit of jumping around when it comes to property taxes and the title policy, because we've got to show them the credits. So, and the credits are shown on a different page. So there's a little bit of jumping around when we're doing that.
You will.
Yes.
I did want to point out, and this is something you can say to your clients, that Texas and Florida are the only 2 states in the nation where we have to do this debit credit and show the title policies the way they are, because
Okay,
this
that's
is a
good.
national form and it doesn't work for us, right?
Okay, that's good. I didn't know that. So that's good to hear.
And that's also why you'll see, that T64 puts all those fees back together. And that's usually the next document behind this one, at least
Sure.
in my closings. And then we also do a borrower's statement where it's just a debit credit ledger. So it makes it a little more clearer than the CD too.
Correct. Yeah. Yeah. Okay, so you can go to the next one. So I'll tell you the biggest question that I get on this page is the assumption portion, because that's a hot topic right now all over social media. Everyone makes it sound so easy and so simple. So it's a hot topic. So on a conventional loan that box is going to say no. A conventional loan is not assumable. On a government loan, the box that says it will allow under certain conditions for the loan to be assumable. Okay. And then it's just demand feature. Conventional loans do not have a demand feature. Okay. Most mortgage companies don't want to call the note due. They don't want to have any negative press. Okay. And then the next section is the late payment. If your payment's more than 15 days late, we're going to be charged a small late fee of 5% of the principal balance. You have until midnight on the 15th at 11:59 to avoid that small late fee. And then mortgages aren't reported late until your 31st day. Okay, that's when you get a 30-day late on your credit report. The next section is negative amortization. It's still there are really not any negative amortization loans on the market anymore, but you still have to have this verbiage in there that this loan does not have a negative amortization. And what that is you're only making a minimum monthly payment like a credit card, and it's tacking on unpaid principal or unpaid interest or principal balance to the end of the loan. Okay. And then of course the lender does not accept partial payments. Unless you're in a loan modification agreement, they might accept partial payments, but under normal circumstances, they are not going to accept any kind of partial payments. Okay.
So we'll address the fact that we have some clients who want to pay 2 payments a month. Tell them how they can do that.
Yeah. So when someone wants to make a payment every 2 weeks, like a bi-monthly payment or bi-weekly payment, they have to be paid 1 month in advance. Okay. Because when you make a payment every 2 weeks, some of those payments are going to fall after the 15th, and you're going to be handled that 5% late fee. So the servicers will want your mortgage paid 1 month in advance before they will set up that every 2 weeks payment schedule, because they don't want to be dealing, to be honest. I mean, I don't want to deal with anybody that calls every week to ask for the 5% late fee to be reduced. Right. So you got to be paid 1 month in advance to be able to do that. Okay. And by doing that, you're making 13 payments a year, which is going to cut 5+ years off a 30-year note. Okay. The next section is just your escrow analysis. Your total amount for escrow property cost over year one, your initial escrow payment, monthly estimated escrow payment. So you've got all that broken down. Okay. And so you can go to the next page. Yeah, to be honest, I just tell people not to look at this page, because it shows the total amount you've got to pay in principal and interest over 30 years. And then it breaks down the principal and interest and what the APR is. So, unless you want to be depressed, I mean, not to look at this page. APR, I get asked that question a lot. APR is your cost of credit. It is not your note rate. Your payment is based off your note rate. This is your cost of your mortgage expressed in an interest rate. So included in that is fees, right? So as an example, this loan has private mortgage insurance. Private mortgage insurance is considered a fee. So that cost is built into the APR. Okay. Your goal would have your APR to be as close to your note rate as possible, to show you are paying less in fees. Okay. But you've got to explain to people that it also includes PMI and the percentage of your PMI every month. Okay. I think that's it. I mean, this is what I go over. The last page is who's working on the loan. So in this case, it's Benchmark and myself. And then you have the buyer and seller's agent, and then the title company. Okay. These are all your points of contact. Okay.
Hey, Will, great job, bud.
Yeah. If anybody has any questions, Mike and I do this on Fridays for all our customers that are closing the next week on Monday, Tuesday, Wednesday. So we're happy to answer any questions and break it down, and you can direct the clients to us so that you don't get lost in all this mortgage jargon. We're happy to do it. Anybody have any questions?
Yeah, I'll tell you one thing, Will, that is really key. I've actually had a lot of people send me other companies' closing disclosures and closing disclosure to the client because the other lender didn't explain it. So don't ever feel like you can't call us if there's something you've got on somebody else's disclosure. We're there to help with that as well.
Yeah, it is rewarding when we go to a closing and the escrow agent asks, hey, have you reviewed this with your lender? And the answer with us will always be yes. It will not have any questions on this because either Mike, myself, or Shelly will review it line by line with each closing we have, so they don't have any questions, right?
I was just going to say is every time I have a Benchmark closing, it is done 6 days early. It is the final closing disclosure. I'm not getting documents or, changes at 11 o'clock the night before. And every time I have asked, I know your lender's gone over this with you. Did you have any questions? Nope, we're all good. And most of the time, y'all are sitting in the room with us anyway, which is a rare occurrence these days.
Yeah.
So I appreciate everything in the way y'all process and do. It makes a difference all the way around.
Yeah, I'll tell you, we try to live by the spirit of this document, which is to provide the spirit of this document is to provide your final number due at closing. Okay, so we have some that we work with, that we broker to, that will send it out as soon as you have a loan approval. Well, it's not final. They're just trying to start the 3-day clock so they don't bump into the closing date. Our goal is to not even approach that and be clear to close well in advance of that closing date and have no timing issues to get out the closing disclosure. We're going to follow the spirit of the document.
And that's another thing too, is that what people don't know behind the scenes is these documents get sent to our title company. And there's a balancing, making sure going back and forth. And I will tell you with Alicia, we don't have to wait on those documents. It's balanced right away. And that's an important part of this transaction so that we can get those finals out to the clients. So thank you. I want to reciprocate that comment, Alicia, and tell you how much we appreciate that as well.
Yeah, I 100% agree because Mike and I do not want to call someone on Friday night at 8 o'clock at night to review the closing disclosure and tell them it has to be signed today because of a lack of response, right? So it's always great working with Alicia because we don't have to do that, right? No one wants to talk to me Friday night at 8 o'clock about mortgage. So,
Especially if the CD is unbalanced and you're saying, just sign it anyway.
yeah.
Hey, I hear that all the time. Let's just get the clock started. And
Yeah.
we do. I'm like, okay.
Does anybody else have any questions that we can answer?
Did y'all find this helpful?
I did. I have a closing today, and I'm definitely gonna be a little bit more informed on it especially because I'm newer, and so I mean, there's so many numbers and terms that are thrown around that I still don't really know. So, so that was helpful. Yeah.
Yeah, and I'll just reiterate what Tom said. Even if it's not us and you need help, we're gonna help you, right? So if you have questions and you can't get a hold of somebody, you want to know to be prepared for closing, you want to help educate your client. If it's not us, we're still here to help. Doesn't matter.
Well, I definitely appreciate the time today and the information. And I had a client recently that we had a big issue on the disclosure. And unfortunately, I tried to push benchmark at the beginning. He said, "Oh no, I've used this guy a bunch of times." Well, of course, it was a nightmare. And they didn't know what was going on. They got the CD and then he was like, these numbers are wrong. So me and Brittany got on the phone with my client, trying our best to go through it because the lender was just, MIA. And so, man, this is one thing I appreciate about you guys, and huge value add, and just one more reason to make sure our clients are, getting pushed your way so that they get the best experience possible.
Yeah, and I appreciate that, Brandon. I mean, the next time that happens, we're happy to go over it. I just, we're all a team. We can all work together and get it done for what's in the best interest of the client. We're happy to help. All right, guys. Well, I tried to keep it short so you could go enjoy your Friday and you didn't have to listen to mortgage for an hour. But you can reach out to us directly at any time.
Happy Cinco de Mayo to everybody.
Yeah, happy Cinco de
that's
Mayo. We'll have
right.
some tacos today.
Happy Cinco de Mayo.
Hey, viva, viva! Ay, 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 ay!
I
Who
couldn't
was that?
convince,
That's my dad.
I couldn't
Okay.
convince
I was
Will
gonna
to
say,
wear a
there's
sombrero.
no way that was Tom.
Thank you, Mr. Sherman.
All right,
Awesome.
guys.
Awesome.
So, okay,
See
this
y'all.
has been recorded. I'm going to go ahead and stop it now. If you